liquidity events, the likes of which sent bond yields and stock prices spiralling in mid-October, may be over, but there are concerns that a similar event may occur again. With economies fluctuating rapidly, can the worries be subdued? Joining me to give his insights into the bond market is Mirko Visco, Managing Director at Generation Alpha. Thank you for joining us.
Good morning, Alex. Thank you.
Mirko, do you think a bond blow-up is likely as economies grow but rates remain the same?
Well, growth in a low market condition is not necessarily bad for the markets. In fact, this is what we've had until now. Central banks have provided a lot of liquidity and investors have enjoyed very nice return. But eventually today the situation is different. As we can see from the chart, the central banks' balance sheets have widened a lot in the US and in England, where in the other side, Europe and Japan are just starting right now to grow their balance sheet. So the reaction was that simply Europe and Japan have been lagging the others in terms of economic recovery. In terms of the bond market, the situation will be very critical going forward. I think if we go back to the US, we are eventually ready for a 5 to 10% correction in the bond market, simply because if the Fed start to raise rates, market will really act differently and people will start selling off bonds. We can see from another chart that the Fed is eventually in a situation to start raising rates sooner than later. In fact, the unemployment rate is trading below 6%. Any further growth in the US economy could be inflationary. So the situation could be different today in the US market. Until now, equity managers have been using government bonds as a hedge, and in fact a much better hedge than buying volatility. But things can be different. Globally, bonds are a pretty rich valuation. The next chart will show that they are all trading. At least more than one standard deviation away from the long-term trends. So if the market realizes that the Fed is going to act and to act on a continuous basis, I think government bonds may drop further. So as investors, I would try to play this market differently. Invest in European-denominated bonds because the ECB is there to maintain interest rate low, or invest into high-yield and emerging market short and medium-term bonds where credit risk is more important than interest rate risk.
Banks now have less power to offer liquidity in the bond markets after the crisis of 2008. What does this mean for the market and brokers?
Well, for the markets and for the investors, it means a lot. And we've seen that after 2008, any change of market trend, any lack of liquidity, any negative news has been translated with much higher volatility and much bigger price actions. And the Bollinger charts are really showing that the bands have widened quite a lot. Today, the liquidity is provided by the big funds, by the big hedge fund managers. They are there to support the market when necessary. But the banks, they've just become new and additional brokers.
And finally, is the future safe for investors?
Safe depends on the definition of safe. It's certainly more difficult right now and less easy to invest because you cannot just buy government bonds. Today, people that invest in government bonds should accept negative or zero real rates, and we see that from the government bond, the government inflation-linked bonds, that the real rates are really close to zero. So in practice, that is translated by wider diversification in terms of investments, and eventually look for decorrelated asset classes or investment strategies. I'm giving some examples. Investing in a Spanish real estate investment vehicle could offer both access to yield and asset inflation and less correlation to the traditional markets, or eventually investing in listed private equity funds that can offer access to equity tranches, but are lower at a lower valuation. So it's really key today, I think, to look for more diversification in investments, because simply investing in bonds is not the safest investment anymore.
Thank you for your time today.
Thank you.
So there you go. Make sure you take a few more risks and don't play safe with government bonds. That's all we've got time for today. Make sure you check back in with Dukascopy TV for more news on the bond markets. Goodbye.